Hey, this is Lanier with Century 21. So I normally try and keep my videos pretty short and just kind of breeze through some high-level information about real estate and what's going on in the market. But I think with this issue today, it's important enough to dive in and kind of give it a little bit more time than I normally do. So I want to talk to you today about home affordability, because I think it's the number one issue that my customers are bringing up right now. Gosh, we missed the window. We should have bought when interest rates were lower. Now that interest rates are up at 7%, there's just no way we can afford a home. We missed it. That comes up all the time when I'm talking to customers. And they're absolutely right. Interest rates are up, and just at face value, it looks much more daunting to try and buy a home now than it did 6 months or a year ago. What I want to walk you through today is a pretty realistic scenario of what it looked like to buy a home 6 months ago, so March of this year, versus today. Because things have changed really, really quickly. 6 months ago, you could still get an interest rate in the 4s. Now you're looking at 7%. And some people just immediately count it out and say, can't afford a house, I'm just gonna wait. I can't make my move right now, I'm just gonna wait it out until interest rates go down. And I understand the sentiment. Trust me, I really do. I see it every single day. But let me talk you through this, and let's just see if it makes sense that it might actually be a little bit more affordable than you think, and possibly even more affordable than it was in March of this year to purchase a home. So I'm gonna be real honest, if you're not looking to buy a home, if you have no interest in real estate right now, you're not gonna bear with me through these numbers, because I'm gonna get pretty deep into the numbers on this. So no offense taken if you're clicking away right now, but if buying a home this year is something that you're planning on doing, I really do think this is worth a few minutes of your time. In March of 2022, this would have been a realistic offer that I would have written at this time. List price is $300,000. Well, we were probably going to offer at $325,000 if we really wanted a chance to compete on this home. That's just the way the market was. So a $325,000 purchase price, and we would have had to throw in some appraisal gap coverage. I actually went pretty conservative here and just said $10K. That means if the home appraises at $315,000, we're going to pay that extra $10,000 to get it up to $325,000. Very realistic. Almost every offer that I wrote over the last couple years had some kind of appraisal waiver or coverage gap included in it. We're also going to be waiving the finance contingency. You could not offer with a finance contingency. We're also going to be down at 2 days due diligence. Again, a very realistic offer. Some people were waiving it. A lot of people were waiving it. But let's say we get 2 days due diligence out of this. That's the offer structure that might have gotten you a home in March of this year. So what does that mean in terms of actual money leaving your pocket? That means if you're putting down 5% on that home, you're paying $16,250 as your down payment. You're gonna pay about $6,500, that's a very rough estimate, closing costs, 2% of the purchase price. You're gonna pay $6,500 cash out of your pocket at closing, and then you're gonna have to cover that $10,000 appraisal gap potentially. So the total cash out of your pocket to buy that home in March of 2022 was gonna be $32,750. Now here's where it gets better, because at a 4% interest rate, your monthly principal and interest payment would have been $1,474 every month for the next 360 months, basically. Very cut and dried, very simple. That's the picture of what it looked like to buy in March of this year. Now we fast forward to present day. I'm not writing the same offers that I was in March of 2022. It's changed somewhat dramatically. So let's say that the home's a $315K list price. Again, that's moved up from $300. Prices have come up since March, how hard as it is to believe. They have continued to go up. So let's say it's a $315K list price house, but now you're gonna get it at list price. You may be able to get it a little bit under, but again, I tried to be conservative here. You're gonna get it at $315,000. No more appraisal gap coverage, no more waiver. You get 14-day appraisal contingency. You get a 5-day finance contingency just to make sure everything's good on the loan, and you're gonna get 7 days due diligence. You're gonna get plenty of time to kick the tires and do the inspections on this house. Now, in terms of money leaving your pocket, now we're looking at a 5% down payment again, $15,750. You're paying closing costs again. I'm not going crazy here. $6,300 in closing cost, bringing your total cash outlay on this one to $22,050. But what about the monthly payments, you say? Yeah, that's great. Less cash out of my pocket, but I'm going to be paying more every single month for this house. Maybe. And here's why I say maybe. Yes, you're going to be starting at a 7% interest rate. That's not ideal. I'm with you. I hear you. But right now, it's very realistic that you're going to get the seller to agree at a list price offer. There's a good chance you can get them to agree to a 2-1 buy down. That's a seller paid buy down of your interest rate over a 2-year period. It goes down 2 points for the first year and 1 point for the second year. So that means year 1 of your loan, you're paying 5% interest. Year 2 of your loan, you're paying 6%. And then in year 3, you go back to the full 7% if, and I say if, rates are still high. Now, I think it's totally realistic to think that rates are going to come down somewhere in that window, and you can be opportunistic. When they come down, you refi. On almost all these, there's going to be no prepayment penalty, no penalty at all for refining when rates go down. So what does that do to your monthly payment? Well, that means for year 1, you're going to be paying $1,606 a month for that first year. For year 2, you're going to be paying $1,794 a month every month. Now that's way more than the other one you say. The other one was $1,474. You're telling me my mortgage payment's going to be $300 more a month and I'm supposed to be excited about that? Yeah, I am. Because if you look over the course of that 2 years, you're paying about $5,400 more in principal and interest than you would have if you bought in March. That's not nothing, but remember, you outlaid over $10,000 less cash up front. That means over the course of 2 years, you've saved $5,276 by buying now versus buying in March. So is it really unaffordable to buy right now? Now let's talk about a third scenario. Let's say that you want to flip the script a little bit and your concern is not so much your monthly payment, but it's to keep as much cash in your pocket as possible. Totally reasonable. Let's look at this scenario. Same exact one as the second. $315K list price, $315K purchase price, 14-day appraisal, 5-day finance, and a 7-day due diligence. Now you're going to put the same amount down, that 5%, $15,750. But let's say this time, instead of asking for the buy down, it's close to the same amount. You ask for the closing cost paid by the seller, $6,300. That's $6,300 staying in your pocket at closing. So your total cash outlay on this is $15,750 versus $32,750 from the first scenario. Now, isn't that going to make my mortgage payments just absolutely absurd every month? They're way higher. There's no two ways about it. You're going to be paying $1,990 a month versus $1,474 a month. But let's put that out over 2 years. You're paying $12,384 more in principal and interest payments over that 2-year period than you would have in scenario 1. But again, let's remember, you're paying about $17,000 less in cash. So your total savings over that 2-year period are about $4,600. That's a significant amount of money. Not quite as much as scenario 2, but still a pretty good premium on savings there. But what about after year 2? Doesn't that number just keep getting worse and worse and worse over time? Well, yeah, if you stay in the house for 30 years at a 7% interest rate, it was a bad decision. You should not have done that. But here's the deal. Number one, are you going to be in that house 30 years? Almost never. On average right now, it's about 9 years. And number two, we're saying in that scenario that interest rates never come back down below 7%. I think that's highly unrealistic. I think there's a good chance that in the next year, certainly the next 24 months, there's going to be plenty of opportunities to refinance to a better rate. Now, will it be 2 3/4 like it was when things really bottomed out? No, probably not. But you can probably get a significantly better interest rate in that period. So I'll close with this. There's always going to be risk associated with buying a home. 6 months ago, the risk was you're going to get a really good interest rate, but you might be waiving your appraisal. You might be offering cash above appraisal. You might be getting no due diligence or very little due diligence. That's serious risk. Right now, the risk is maybe interest rates don't dip below 7% for the next 2 years and you're stuck with a higher monthly payment. It's risk. I don't think it's likely, but it is risk. Look, if you find a home that you fall in love with, if you see it online, if you go see it in person, and you think it's the right home for you, but you just don't think now's the right time, you don't think it's a good time to be buying a home, I hope I've shown you today that it really can be. If you're working with an agent that knows the market well and knows about solutions that are available, I think now can be a more affordable time to buy, even with significantly higher interest rates.